So I'm Brian Olson. I am sort of a past person in the grain industry and the last 20 years at the University of Manitoba here. One of the people I've had a lifelong relationship with was Daryl Kraft, for whom this is named after in the Kraft family. And so the Kraft family initiated a fund that supports three initiatives. One is the graduate fellowship, the other is a undergraduate prize, and the third is this Kraft Lecture that is now in the 13th year of the Kraft Lecture. I'll have a few moments to discuss that, but before sharing further details, I want to welcome you and acknowledge that the University of Manitoba is located on the original lands of the Anishinaabe and Cree, Ojibwe Cree, Dakota, and the Dene people, and zone land of the Métis Nation. And the UFM respects the treaties made on these territories, and we acknowledge the harms and mistakes of the past, dedicating ourselves to moving forward in partnership with Indigenous communities in the spirit of reconciliation and collaboration. Now, with regard to this, the 13th year, it was started by one of the first guest was a fairly significant pillar of our industry, Alex McCalla, in 2009. And we've had a really inspiring group of people over the years, the 12 years that followed that. And we do want to thank in any way that we possibly can to the mammoth that effort that the Kraft family made in terms of securing a fund for financing these projects. And the Kraft Fund is something that I think is an example of relatively small donors earning and making a significant contribution to the department. And I'd like to invite Dan Kraft to come up and share on some feelings with regard to his father and maybe a few details in terms of the state of the fund itself. And after that, then we will get an introduction to our speaker from Daryl Kraft, from Derek Bruin. And so,
thanks, Brian.
Yeah, it's amazing that this has been 20 years in the making to this point. When Dad passed, I kind of sat down and said, is there something that we can do to give back to the university that was so near and dear to his heart? And we thought about what were Dad's passions, and it was students. He loved teaching, he loved students, and he loved dialogue in just agriculture here. So we built a fund that we're able to fund speaker series like this, fund 1 or 2 graduate scholarships a year, and then give back an undergraduate award as well. So we're very fortunate, the faculty of the Agribusiness from how we've gone behind this. We're very fortunate. I think we've raised just around $870,000, and that money is just going back into students and teaching, which Dad was so passionate about. So we're just very grateful that this can be a lasting legacy, that Dad's legacy can be keeping us forward, and just the momentum that the department has done. It's really, really appreciated. Yeah, my dad loved students. There were years when I was in university, I was playing junior hockey, and half my team were Aggies. And there were some years where they were all taking Dad's classes, and we were coming to one practice and just getting shunned by half my teammates saying, what did your dad do to us on that exam? So he loved students. He may have had some tricky exams once in a while, but he really did. He was very passionate about teaching and the University of Manitoba. So thank you.
you, Dan, for bringing that up. One of the ways we can remember those who passed on is to kind of give what they gave to us back. And I know that this does something that Daryl did very well, was sharing about agricultural economics that were important at the day. And Jim and I lost a friend, and we did something similar, and it has been therapeutic to remember Dr. Rude that way. And I know that Jim speaks to policy issues a lot of the same way that Daryl used to. I also want to thank Myrna and Dan and the friends of Daryl Kraft for their contribution to our department for this lecture and for the student support. It is my honor to introduce our 13th annual Daryl Kraft Lecture, Dr. James Buchanan. James grew up on a farm, beef and grain farm in Saskatchewan. He actually came as a vocag, so some of those vocag people that when they listen to this man's career, he did go back to the farm for a bit, then got his bachelor's and his master's, and eventually a PhD from the University of Berkeley. He started at UBC in 1991. Apologies. Jim is a fellow and past president of the Canadian Agricultural Economics Society. He's been an editor of the Canadian Journal of Agricultural Economics and the American Journal of Agricultural Economics. He's highly regarded in terms of his published research in many areas, including agricultural commodities, risk and insurance, agri-environmental contracts and policies, all issues that were interesting to Dr. Kraft. Jim has also authored an excellent text in agricultural marketing. He's working on another one in time series models. I thought I'd make that plug for your books. In today's lecture, Jim is exploring the information bundled in the presence of options and, sorry guys, very sorry. So please join me in welcoming our 13th annual Daryl Kraft Lecture, Dr. Jim Buchanan.
Thank you. All right. Well, thank you for that introduction, Derek. And I'm delighted to be here. I hope to meet some of you afterwards at the reception, and we have lots to chat about. And I didn't know Daryl particularly well. I certainly knew of him. His name came up all the time. I was just a young assistant professor at UBC, and I heard about this Daryl Kraft guy who was a real mover and shaker out in Manitoba. And I knew of his work, and I think it was only now when I started to read about him, I think it was in the Manitoba Historical Society, has a really nice description of his contributions. It's like, wow, this guy was amazing, not only in terms of his academic work, but he was contributing everywhere, you know, to our Canadian Ag Econ Society, to the Manitoba agriculture sector in many ways, to the Canadian agricultural sector. He was involved with so many boards, so I think a lot of us are just, you know, we've become too, I think, self-interested, and he was someone who was a real class guy because he always gave rather than just doing what was maybe best for him. Anyhow, so let's, I know Daryl was very interested in policy. My current talk, I think, has got a lot of policy implications, although I won't talk too much about policy today. Now, I might have got some of you here because of the title. It's a bit of an intriguing title, and you probably won't want to leave if I've got you here under false pretense, but I'll try to make it live up to what it's supposed to be about. So the idea is that commodity prices, which many of us don't think about too much, and option prices, which we probably think about even less, they're really a rich source of information, but they're seldom talked about. They're often, we hear today even that the Dow Jones kind of went way down today, and we hear about that in the news, but we don't often hear about, we hear a little bit about oil prices perhaps, but not so much about wheat prices and these sorts of things. And there's actually a very rich source of information about food security and what's happening in our world and what do we believe about, you know, future prices, which are really important, especially now as we are in the middle of things like wars and pandemics. Food security is a real important issue. So today I will talk about, I'm going to start with motivating examples to try to get you thinking about why is this interesting and important. Then I'm going to talk about something about the forward curve. You'll probably know a few new things today that you didn't know before arriving here, a bit of jargon. We'll talk about option prices and something called implied volatility. And then I will probably not get time for this. It's interesting, but maybe we can talk about this over a beer later, and then I will conclude. So, pandemics, wars, and other frightening things. What's that got to do with option prices and futures prices? Well, it turns out that we're living in a really complex time. And we hope that traders who are trading futures and options are not sort of probably, subject to emotional outbreaks like we might be, that they're actually trading to try to make a profit. So they're arbitraging trades, they're trying to, speculating, and through their actions, they're kind of revealing what they believe about the world. Are they thinking, food supply is in jeopardy, or is there plentiful stocks? So we can try to drill down deeper and try to understand what these traders are thinking about, and then ourselves will have a much better idea about food security and the things that we're interested in. So basically, that's what we're going to work through. Okay. Now, as I said, there's quite a bit of jargon in this literature. I know many of you probably are not up to speed on futures markets and option markets. So what I'm going to try to do is have a balance between trying to bring you along, like in Futures 101, and also maybe sometimes you might get a little lost in it, but that's okay. I've got lots of graphs and pictures which will hopefully help illustrate the ideas I'm trying to get across. So let me spend a few minutes motivating why I think this is important. So as I mentioned earlier, when bad things happen, we tend to turn right away to like the S&P 500 or the TSX and say, okay, what's happened? Why is the TSX, down 200 points? What's going on in our world? Well, this is valuable information, but there's also, like I said, a lot of valuable information in the actual commodity prices itself. So sometimes the event might just suddenly start, like the invasion of Ukraine by Russia was like a one day, it happened, and markets reacted strongly to it, okay? So that's something we can be interested in. In other times, though, it might be simply an announcement. For those of you who remember the big meltdown in 2008, you remember what happened during prices were so high and stock prices were so high, and suddenly the financial sector basically unraveled, and there was doom and gloom about recession, and then the US government kind of talked about a bailout. Well, then everybody was happy because of this bailout, and we see that on September 23rd, 2008, crude oil prices soared by $16 a barrel, which is the biggest one-day gain ever. That was just based on an announcement that the industry is going to be bailed out. So these are the sort of things that we're looking at. The oil price had a lot of information at that point. Okay, so let's get started. At the simplest level, we can simply see that the prices will respond to an event. Okay, so let's start with the one that we're all familiar with. Okay, I'm going to show you a graph of when Russia invaded Ukraine on February 24th, 2022. And the question is, what happened to the price of corn? Now we know Ukraine is a large producer and exporter of corn. They about $6 billion worth a year of corn, and about 30% of that is exported to the EU, and about 30% of that is exported to China. So clearly traders are worried that if the Black Sea ports are going to be shut down, that this corn is not going to get to markets, that there's going to be a shortage of corn. So clearly the price is going to go up. Well, let's have a look at sort of how this unfolds in real time. So what I have is a graph. Now, this vertical line here, the red line, is the day that Russia invaded Ukraine on February 24th. Now, already prior to that, the markets were starting to become tight. Corn inventories were starting to become tight. Prices were starting to go up. So this was the last thing we needed, actually, was to have this invasion. So you see already prices were starting to go up. But what I find interesting is that it took a few days for the reality of the war to sink in. I'm not sure if they thought Putin was going to basically in 2 days overtake Kiev and the government would be gone and we'd be, and then everything would be sort of back to shipping corn again. So it seemed to have taken a while, but then the reality set in. And this is pretty substantial. This is like these are cents per bushel. So this would be like $6.60 a bushel. And within a couple of weeks' time, we're up to like over almost $8 a bushel. So a big, big price increase. So that's the kind of the easy way of thinking about that. Prices respond to, in this case, would be a reduction in supply due to the blockade of the Black Sea ports. But there's things that we don't often think about unless you're a specialist. There's something called the price spread. And you're like, what the heck's this price spread? Well, futures prices, the beauty of future contracts is that they trade not just the current prices, like right now we might be trading in November futures, which is nearby, but we're also trading January of 2024, March of 2024. In fact, we'll be trading, probably January of 2025 already. Why do we do this? Well, because we're worried about, we want to have, things are happening in the future and we want to have unique prices for today and in the future. So future contracts allows us to kind of separately price events today versus in the future. That's why they're strong. So the spread between a future price, for example, what the November 2023 contracts are trading at, and say the May 2024 contracts, that's the spread. Well, if that spread is really large or really small or even negative, that reveals something about what traders believe about the current status versus what the future status is going to be. Let me give you an example. If the current price is above, if the November futures are above the March 2024 futures, there's clearly a current shortage and there's going to be plentiful supply in the future, right? Because that's, okay, so that would be one way of looking at it. So we're going to look at the spread as a way of understanding it. Now, I think many of you will remember this. Of course, I think most of you remember the pandemic. That wasn't that long ago. We're still almost in it. But this was really interesting about, you remember when the price of oil went negative? Big headlines. It was, okay, so this is good, gives you a good example of what happens when the futures contracts spread apart. So here we are, pandemic. So this is like the early days of 2020. We're hearing news from Italy. Things are getting weird. What's going on? It's not going to happen to Canada, right? Well, maybe. We're getting closer. We're starting to see problems. This is the oil price, right? So we know that if there's a pandemic and the global economy shuts down, we're not going to be traveling and we're not going to be shipping goods, so the oil will be a lot less demand. So prices start to come down and down. And we're getting close to the middle of May, and that's when the May futures contract expires. You have to make sure your contracts are fulfilled before the contract expires. You have to, you're legally, otherwise you lose a lot of money. Suddenly traders are they have all this oil that they're supposed to be accepting and they're supposed to be using, and nobody wants it. The big tanks, ocean liners, everything is full of oil. There's no more room for the oil. But yet the oil has to come from somewhere because the refineries keep pumping it out. And there was all sorts of problems with like Saudi Arabia and Russia. They couldn't agree on trying to cut back the production of oil, even though they knew the demand was going down. So lots of politics were happening. Anyhow, what happened was there was simply that traders had to pay people to take their oil. Because rather than being paid for your oil, you had to pay people to take your oil because nobody wanted it. There was so much surplus. And we actually saw the price of oil go negative until the May contract was fully expired. The June contract sort of it plunged and then it started to recover a little bit. So that shows you why we have to be interested in the spread between contracts, not just the price itself. So that's my second motivation. Now, option prices are even a bit more of a mystery, and for a non-specialist audience, it's a bit harder to explain, but I'll do my best. What can we learn from option prices? So think about it this way. If you believe that there's going to be a large price drop, you're going to buy what we call a put option, okay? And a put option has what we call a strike price. And when you buy the option, so if the futures price drops below the strike price, then the option becomes valuable. And the more it drops below the strike price, the more valuable it is. So can you imagine if you took like a long shot, if you bought an option with a really low strike price and you figure, what's the odds that the price is ever going to go way down there? Well, you can buy those things for very inexpensive. You maybe only, the options sell for next to nothing. But they are important because they reflect the likelihood that we could have something really bad happen and the price going like really low. So they trade. So people who are basically, looking at long shot black swan events will trade these sort of put options with low strike prices. On the other hand, you have something called a call option. A call option is just the opposite. It becomes valuable if the price rises above the strike price. So if you buy a call option with a really high strike price, it only becomes valuable if the future price surges way up, okay? So maybe you're seeing where I'm going with this, right? What do you think is going to happen when, for example, Russia invades Ukraine while you're worrying about the prices going, or the, okay, I'll talk about that. So now you're worried about the price spiking way up. So anybody who's holding these call options, could actually be potentially valuable. Anyhow, what we're going to be interested in is these price of these sort of what we call way out of the money options, because they reflect what traders believe about the likelihood of these black swan events. The technical jargon is we call them fat tails, because we normally think of prices having a normal distribution, like most things have a normal distribution. And in fact, the option pricing mechanism assumes there's a normal distribution for prices. But after the 2008 crash, people started realizing that the normal distribution wasn't very reliable. And in fact, the tails are more fatter. They're more likely that there could be events happening in those extremes. So we call them fat tails, but we can call them black swan events. And we'll get to that as to why that's important. What we can do, I guess what we do though, and maybe the most important thing is that the options look at this way. If you hold an option, you buy it, the most you can lose, suppose you buy an option and you pay 20 cents for a bushel of say, soybeans. It's not that much money. The most that can happen is the option expires and you lose your 20 cents. Not a big deal. But if the price surges well above, you can make a lot of money, right? So it's like you can't lose much, but you could gain a lot. So the more volatile the prices, the more likely it is that you might actually have the black swan event that you're looking for and you can make some money, right? So the options measure volatility, and we call that implied volatility. The price of the option itself reveals what traders believe about how volatile the prices are going to be. So if you have an event like the invasion where no one knows what's going on, how's this going to unfold, this invasion, then the prices become like, yeah, we could end up with these really big bad things happening. The option prices go way up, and it reflects the uncertainty. So we're going to use this sort of implied volatility as a way of understanding how traders believe about how volatile the world has become when these bad things happen. So let me show you what happens with crude oil has its own measure of implied volatility. So this is you can mirror this is every day you can look at what the implied volatility of crude oil is looking like. And I don't understand quite, I haven't taken the time to understand. This starts in like late 2022. The volatility was very high, and maybe some of you who are more in tune with the business world, the volatility was very high back in late 2022, and it was steadily declining until something happened here where the volatility spiked up. Now, my bit of reading made me think that it's had to do with China. China has been going through a lot of issues, right? Whether it was coming out from its lockdown and having that sort of disastrous, issue there, and now its economy is sputtering. So I think a lot of this volatility with the oil price has to do with concerns over the Chinese economy. So I don't quite know what's going on here. This is the thing that really puzzles me. This is like hot off the press, as we know, with the unfortunate war, the new war we have now in the Middle East. When I first looked at this graph, I was almost certain that this would have been the day of the invasion right here, and that as soon as the invasion happened, that the uncertainty, obviously when you're dealing with Middle East wars, oil is the first thing that's going to get hammered, right? So I was thinking that this was the day of the invasion. It turns out the red line is the day of the invasion. So oil price uncertainty, volatility, was already going up almost 6 days before that. So like, did the traders actually know of something about this war before governments did? It's weird, but it just seems coincidental that the volatility was already going up so high, and then this sort of invasion seemingly happened out of the blue. Okay, so that's another issue. And finally, volatility is interesting, but it doesn't really break down whether it's on the downside, whether we're worried about prices collapsing like a recession, or whether it's on the upside, like with the invasion, that we're going to have big price spikes. So we have one more tool in our toolkit to break this down. We can separately look at the put options. The put options are going to actually tell us the volatility of the downside risk. Remember us telling you about flat tails? If the put options are trading at a high premium, that means then that traders believe that a downside black swan event, like something bad is going to happen on the downside, and they're trying to buy the put options to hedge themselves against that. So we can look at put options volatility separately from the call option volatility as a way of trying to understand if traders thinking, is this a downside issue or is this an upside issue that we're worried about? So we can use that as well. So that's my motivation. Now let's get into some of the actual data and start to look at wars, pandemics, and other frightening things. I haven't quite figured out what the other frightening things is. I think pandemics and wars are frightening enough, but maybe there's things else out there that we will come to learn about. So this is, yeah, I guess I should have said, so this is one example of how we see the difference. Clearly, this is the crude oil again, October 18th, so the Middle East war is well underway. If you guys were students in my class, I would give you a question and I would say, okay, tell me, are traders in the oil market now more worried about upside risk, black swan events on the upside or on the downside? And the students would have to look at this graph and they would say, well, clearly these are the put options because this is where the worried about the low prices. They don't seem to be too worried about low prices of oil right now. They seem to be very worried that the war is going to be disruptive and that the oil price is going to go surging up. So the call options are trading at a high premium, which reflects the worry about black swan events on the upside. So that's what you'd have to answer to get full grades on the exam. Okay. So let's go back in a bit of sort of futures market 101. Let's talk about forward curves so we can drill down a little bit. So what you have to understand, and I told you about this a little bit, on a given day, there are many contracts that are trading. Let's take soybeans, for example. And these are all mostly US traded contracts. So right now, the November 2023 soybean contract is trading. We also have a January 2024 contract. We have a March 2024, May 2024, and so forth. In fact, contracts will trade for like a year. So already this November 2023 contract, the one that now is most active, it was already trading a year ago. Okay, so hedgers, people who want to protect themselves against price risk, speculators, they're taking positions in contracts that are many months out into the future. So that's we can get that information to help us understand about what traders believe about the world. Okay, and so this is the case for soybeans. There's like 7 contracts trade every year, and they actively trade for like a year and a half. Now let's have a look at. This is what you would look at if you went on the Chicago Mercantile website. This shows you, and it's kind of a funny symbolism. This would mean soybeans in January 2024 contracts. Well, let's look at here, the closing price. Let's look at the opening price. It's easier for me to see. The opening price on October 18th was, this is in cents per bushel, so $13.05 a bushel and 2/8 of a cent. So don't worry about this last bit. So basically, a little over 13 cents a bushel soybeans were trading at. Now, if you go and look at the March 2024 contract, they were trading higher, 13.18. May 2024, 13.32, and July 2024, 13.37. So you can see already that the further out you go, the higher the price. Now, what are these prices actually telling us? It's very simple. They're simply saying, what do we believe the actual cash price of soybeans are going to be when these contracts expire? So these traders believe that next March, soybeans will be selling for $13.18 a bushel. And next July, soybeans will be selling for $13.37 a bushel. So that's simply what do we expect the price to be when we get to this month, when the contract expires. Now, you might wonder, well, why do you get a higher price in the future? Well, because if you have to store the soybeans, you have to be compensated for it, right? If I was going to store my soybeans from now all the way to next May, I'd better get some money for my compensation for storing it. So this is why the prices have to go up to reflect the storage costs. Okay, so that's quite simple, sort of Econ 101 type things. Okay, good. So that's now the spread. Then arbitrage means there's always people looking to make an easy buck, right? So if you were someone who could buy soybeans now for $12.86 a bushel and store it in your big bin somewhere and sell it for this price, well, if your cost of storage was low, you would do that. That's called arbitrage. So what we expect is that these price spreads reflect the cost of storing the grain from the one period to the next. Okay, so that's your Econ 101 sort of lesson for these forward curves. Now, it gets a bit more complicated though, because these prices don't always go up. Sometimes the future prices are lower than the current prices, and you'd figure why would you ever store grain if you're going to get less for it in the future than you could get it for it now? It's been a bit of a puzzle for economists to explain this, so we come up with this thing called convenience yield. And it's kind of a term to mean like when things are really uncertain, you want to have stocks on hand. You don't want to sell it and be left maybe high and dry and not having the stocks. So even though you could get more for it by selling it now, you decide to store it in case you're going to need it. So we call it the convenience yield. So it helps us to explain why there are times when prices will be lower in the future rather than higher. And this is important because we know that in the annual production cycle, we know that when harvest comes, prices are at their lowest point. Okay, so in the US, if you're talking about wheat, harvest, they've got winter wheat, so harvest happens like in June, July. So prices should be lowest in June or July, and then the cost of storage is bringing the price up, and then as the stocks start to run low, we hit the highest price, then the new crop comes and they go down again. So we should see this cycle, and I'm going to show that to you. So this is, I went in and I took the long-term average monthly price, in this case of wheat. And this shows you month by month what the actual price would look like. So as I just said, these low prices correspond to the US harvest of winter wheat. Okay, so that would be like June and July. And these high prices reflect the springtime, just before the new inventory is available. So if we were like in a normal world where everything was straightforward, we had production certainty, the world wasn't weird, we would expect the cash price of wheat year after year to kind of cycle up and down. The part that's going up, there's storage costs. That's why the price is going up, because people have to pay to store the wheat. When the price is coming down, it's convenience yield. People are wanting to hold their wheat, and despite the fact that the price is coming down. So that's kind of the theory. So this is sort of our nice world. Now, I'm going to explain one thing about kind of rolling over contracts. Most people, when you look at the data, you're only looking at this most recent price. So when you look at the futures price, you don't tend to look at all these prices. Only the kind of nerdy people do that. We tend to just look at this most recent price. So in a month from now, this contract is going to be gone. The November contract will be expired, and we are going to next be at our, this would be the next contract, okay? So now we're in November 15th, and now their next contract to trade is our December, okay? And we can keep doing that. A month from then, so in the middle of December, our next contract is going to be the January. And why this is important is that, it's important for a number of reasons. When you're an index fund or a hedge fund, what you're doing is you're simply rolling your position over into the next to expire contract. So right now, the index funds, the hedge funds, which they're a big player in this market, they're all holding November futures. But come mid-November, which is when the November is close to expiring, they will automatically roll into the December, in this case here, in the case of oil, it would be the December futures. And then, so they're rolling in sort of month by month. And I'll explain why that's important in just a bit. Okay, so now let me talk to you about, I talked to you about a normal world where prices go up because after harvest and they come down with the new harvest and you get this. But obviously we don't have a normal world. We have weird things happening all the time, whether they're pandemics or wars or who knows what it is. Chinese policy, in terms of surprise imports of something, or India not wanting our pulse crops anymore because of something Trudeau said, and there's all sorts of things go on, right? So we can talk about. Let's first of all look at the forward curve, the slope of the forward curve. So what I mean by slope is, let me just go back. This here would be a flat forward curve, because as you go out over time, sure, you've got these sort of interseasonal undulations, but what I'm talking about is the overall, in other words, the stocks are fine. There's nothing to worry about. Everything is good. But what happens if you were in a situation where you had a glut of stocks, like you had big production in some regions, or we had, you know, a recession where we weren't demanding as much. So now we have too much stocks relative to what we need in the future. Well, then we end up with what we call contango. And this is, my students are always like, contango? Is like, is that a dance? Or like, what are we going to do with that, right? It's kind of a funny name, but what it means is that we have too much stocks now relative to what we need in the future. So that means that the storage costs are relatively high, and there's less demand now than there will be in the future. So the forward curve is sloping up, okay? So that's all you have to sort of remember. Contango means that we've got a forward curve sloping up. So imagine now in a scenario where something happened and I'll come back to this, the 2008 meltdown, the financial crisis. Well, all of a sudden then it's like we're in a huge recession. Nobody wants all this wheat, and we've got too much. So we would expect when the 2008 financial crisis exploded, we would expect markets such as wheat to switch into contango, because there's just too much inventory relative to what we currently need. Obviously, you're saying, what about the opposite case? What about when it slopes down? I know you're thinking that. I'm going to tell you, right? And this has got a better name. It's called backwardation, okay? Backwardation is backwards from what we would expect, right? And here we have a scenario where you still got the seasonal cycles, but overall, it's coming down. What would be an example of backwardation? That's what happens when you have scarcity, like when you have some bad, low crops, and the inventory has run down, and people are worried about, no inventory will be better in the future, okay? But right now we're scarce. So what we see is that the prices are a bit up to this relatively high level to reflect the scarcity, to try to encourage people not to buy so much. And then the idea is that the convenience yield is really high. So that allows the forward curve to slope down. This is the Econ 101 prep. So when we start talking about the examples now, you'll understand when I say, hey, the forward curve flipped up. You'll say, oh yeah, I remember that from my Econ 101 prep, why it does that, right? I'm sorry, I'm talking to you like I do with students. That's a bad habit of mine. So, okay. So here, now we finally get to the applications. So let's start to use all what we've learned to see how we can understand some of these applications. First of all, I want to show you, this is something I just took from a study. He's done a very careful analysis about the relationship between the stocks, the global stocks of soybeans, and what the forward curve looks like. So in this situation here, this is pretty much the normal year I was telling you about. Prices are down at harvest, prices go up higher, in the in-between harvest periods, etc. And this would sort of be normal inventories. This is a case where there is no scarcity. There's like lots of inventory, in fact, too much inventory. It says here scarcity is 0. This was in August of 1999. And the dots are the actual prices of those forward contracts. So what they've done is these economists have fitted the forward curve through there to show that the forward curve definitely slopes up when you have lots of inventory. So it just kind of confirms what we believe. And here's one where there's high scarcity. In March of 1997, there's few stocks and the forward curve slopes down. We're in backwardation. So it kind of just confirms what we think. Anyhow, let's talk about this nasty war that's happening in Ukraine with the Russian invasion, and what can we learn about what happened in the early days of the invasion, and then what happened as the war progressed. Okay. So, as I told you before, the invasion threatens the closure of exports of not only corn, but they grow lots of rapeseed and wheat. All of those exports were threatened. So all those prices went up. But as I said before, sure, that's kind of predictable. The prices go up, but we're also interested in now the slope of the forward curve. So let's think of what should happen, right? We would think that, hey, hopefully this war is going to be short-lived, right? It will be over soon. So maybe it's going to be just a short-term disruption. So the current prices, the current future prices are going to surge up. But those later future prices, like next spring, no, all will be good again. So they shouldn't be impacted. Okay, so let's have a look at what actually happened. So this would be a clear case of backwardation. current shortages, everybody's desperate to get the grain, but no problem in the future. So we should expect the forward curve to be sloping down. Let's see what actually happened. So this here, the blue line at the bottom was your typical forward curve. I measured it back in February of 2017, just kind of a representative forward curve. It's not very exciting, it's pretty flat, right? Now let's look what was happening. Here, the red line is just before the invasion, February of 2022. You can already see that there's backwardation, and I was telling you earlier, the last thing we needed was this war because the markets were already starting to feel the pinch. Inventories were low, post-pandemic demand was high, so we're already seeing this, this backwardation. And then when the invasion happened, and this is like March 4th, so a week or so after the invasion, we get much stronger backwardation. Now traders are really worried, so the current prices, like that would be back then, that would be like the May contracts and the July contracts, they went shooting way up. But these contracts, like a year late or 2 years later, everyone thinks, no, the war will be over by then, so they're not impacted at all. It's only the current prices that are impacted by this threat of war. So now we can get inside the head of traders as to how long they believe this war is going to last, based on how quickly these curves converge. Okay, so many of us remember the 2008 financial crisis. I think it took us by surprise. I think we were more concerned about the really expensive bread that was going up to ridiculously prices because everything was like really high, right? Like oil prices were like $150 a barrel. Wheat prices were trading at double what they are now. Everything was just really expensive in 2008, right? And we remember what happened, right? It's the financial, there was all these issues in the US about these bad loans that were put together, and it unraveled very quickly. So let's see if we can see what happened during this wheat prices during this 2008 financial crisis. So in March of 2008, like everything else, wheat was trading really strong. Stocks were low, wheat price was really high. So not surprisingly, we would expect it to be in backwardation, right? We had a strong current demand, traders hoping that the next harvest will be better, so we would be in strong backwardation. All of a sudden, financial crisis, the world's in a big recession. Bang! Nobody wants to wheat because everything is just like, okay, well, not nobody, that's an exaggeration, obviously. And so what happens? Now all of a sudden this wheat kind of is a glut on the market, and it has to be stored for the future, which means that we have to pay these storage costs, so we should switch into contango, right? The forward curve is going to slope up. Low prices now, we don't need it. Higher prices in the future when we need it. So just with this very quick, unraveling, like that happened over like what, a 1 month period from all is good to all is bad, we should see the forward curve in wheat switch from really strong backwardation to fairly strong contango. Well, let's see what happened. So here we are well, first of all, here's wheat prices up around $12 a bushel before the meltdown, and after the meltdown, they're around $7 a bushel. So that's the first thing we noticed, was a huge price drop as a result of this, of the meltdown. But as we predicted, the market was in backwardation prior to the meltdown, reflecting current scarcity. And then immediately after the meltdown, we're in strong contango. The wheat is not needed now, it's going to be stored into the future. So again, gives us sort of a glimpse as to what traders are believing about when the stock is needed and how much response there was to one event. Okay, what about the pandemic? What happened to the wheat forward curve during the pandemic? And again, we can sort of ask about, let's break it down by contracts with different maturities. I think we were all pretty naive. Remember the early days of the pandemic? We thought, oh damn, I might be out for a couple of weeks. When I left university, I thought, well, I might be away for a week or so. I better take my laptop with me. Yeah, little did we know what was going to be happening, right? Well, I think this is what we can see. We can sort of see traders thinking, well, this pandemic thing might be short-lived. So we should see the short-term contracts respond big, but the long-term contracts respond less. So let's have a look at what actually happened to see whether our predictions are correct. So here are this is a bit different now. This is the actual prices of the different contracts from the early days. This would be March 19th, so of 2020. So now I think the World Health Organization has said, yeah, we're in a global pandemic. And here we are in the 23rd of March. So this is a very short time span, okay? This is only like a 3-week time span. And what we see here is that in the early days, this is the May contract. That's the close by one. It's the one, but by the way, the pandemic means that, oh, I think I'm missing the important part of the story. Let me back up a little bit. The pandemic was really interesting because what happened was initially traders thought, oh damn, pandemic means recession. Based on the 2008 experience, recession means commodity prices like wheat go way down. And that's exactly what happened, right? Wheat prices plunged because everyone thought we're going to be in a recession and nobody wants to wheat. But the May price plunged by a lot more than the December 20 price, and that plunged by a lot more than the May price, which is expected. But then suddenly traders started to say, wait a minute, this is more serious because we might not be able to produce food. If this pandemic is so serious, like the flour mills will be shut down, the exporters will be shut down, farmers might not even be, everybody might be sick to plant food. So then everybody started freaking out, not about too much wheat, but about a shortage of wheat. So what we saw is a steady increase in the price of wheat to reflect the fact that we might be short. But it converged quite quickly, this kind of idea of, by then we knew we're in it for the long haul, so there's no need to kind of discount the short-term contracts relative to the contracts a few months later. It's all bad. So that's sort of my take on it. Okay, so that covers off my bit about sort of forward curves. I think we've learned a lot about price spreads and what contango, backwardation. There will be a little quiz after this. Those will be on the quiz, backwardation versus contango. Okay, so now let's talk about implied volatility, a bit more challenging to understand. Remember puts and calls? Okay, we're going to get back to that. So this is just a bit of math. We don't need to know about that, but just let me explain it again. Just remind you, a put option has value when the futures price falls below the strike price. The lower the strike price, obviously, the less likely the futures price is going to come down that low, so the cheaper you can buy the option for. If you want to buy a really cheap option, you buy something that's got a really low strike price and you can buy it for next to nothing. But the odds that it'll be of any value is next to nothing because it's like a black swan event. And the same thing on the call side. You buy like a call with a really high strike price, the odds that the price will rise above that strike price is low, and you can buy them for cheap. Okay, so that's what you need to know about these put and call options. What's important though is that they measure volatility, because if you bought a call option with a pretty high strike price, if there was very little volatility in the price, well, the odds that that price is going to jump above is next to nothing, right? But if the really high volatility, yeah, you've got a much better chance that it might actually jump above that strike price. So the cool part about options is that through reverse engineering, you can look at the price of an option and you can figure out exactly what traders believe about price volatility on that day. You don't have to wait for 2 months and collect the data and measure the standard deviation. You can just say, no, right now traders believe about here's how much risk there is in the left tail and the right tail of the distribution. So it's a really neat way of kind of understanding volatility. Okay, so this is what you would look at if you went on the Chicago Mercantile Exchange website. As we predicted, so as the strike price is in this case going higher, right, we expect call options becoming less and less valuable because the higher the strike price, the less likely the futures price is going to jump above it, so a less valuable call option. On the other hand, the higher the strike price, the puts become more valuable because there's more likely the price will be below that. So that just kind of reflects that. Okay, so we don't have to worry about this. For those of you who are familiar, something called the Black-Scholes is a very, very well-known model. It's used for pricing options, okay? But it assumes, a critical assumption, it assumes that prices sort of have this nice normal distribution. And up until 2008, traders just had on their calculators, Black-Scholes, what should I pay for this option? They would just plug it in, they would do what the calculator said. But after the 2008 meltdown, people started realizing the probability of having something really bad happen is much bigger than what this Black-Scholes formula is telling me. So I'm going to start I'm going to pay more for those options because I don't believe Black-Scholes type of thing, okay? So this just shows you, this is a Black-Scholes calculator. It just shows you that as the price goes up, the implied volatility goes up. So just by observing the price, we can get an understanding of what traders believe about the volatility. So that just confirms that. That's if everybody was using Black-Scholes. But here's what actually happens, okay? So this is what, if people were only using Black-Scholes, everybody at different strike prices, everybody, as for the puts, the price is coming down because there's less likely the put is going to have any value, and the volatility remains the same. But if you were worried about a black swan event, like the price dropping below at a much higher probability than what the Black-Scholes said, because you thought they had fat tails, black swans are more likely because the world is so weird, then you start paying more than what the Black-Scholes model says. So here you're paying 33 cents for the option rather than 18 cents. But if you then, what that translates into is equivalently a higher volatility. So what we can do is we can actually look at the market price of these sort of, deep out of the money options, and we can basically calculate what volatility is implied by that. And then we can graph it. And this is what we're going to do. And yes, economists like to do cute things, and this is called a volatility smile. You're like, okay, I didn't invent it, but I have to use it, okay? So it's called a volatility smile. Why? Well, because it looks like a smile. And what's happening is this is when the options are at the strike price. Here are the puts. As you start to move further out of the money, it's less likely, but now we start to worry about the black swan events, right? And traders are saying, I don't want to get burnt. I'm going to pay more for this option. And it's revealed as a higher volatility. So the extent that we're off the red line reveals the extent that traders believe these black swan events are increasingly likely, okay? So when we look at the data, we can actually see to what extent that we get a smile. The bigger the smile, the more the concern about black swan events, okay? No smile, no concern. Kind of weird, right? Okay, so that's the theory. Let's jump into some of the data now. So first of all, let's return to our Russian-Ukraine war and see what we can learn about volatility from this, okay? Here's the actual implied volatility from wheat options, okay? And remember, sorry, not the war, this is the pandemic we're going to start with, okay? This is the early days of the pandemic. And the volatility for wheat is quite low. We're down around 20%, right? And this was, what are we, February? So yeah, we're hearing a bit of stuff about the pandemic, but no one's too fussed about it yet. So the volatility is quite low. Suddenly we hit now, maybe here closer to March, things are starting to get a bit more newsworthy, but it's really here when we hit, I guess, March of 2020, when the volatility of the wheat market really starts to take off. Initially, again, because we thought there's going to be a recession, nobody's going to want the wheat, so the price was really low, and then saying, no, we might be hungry, everybody wants the wheat, and then the price is going to go high. So in that case, we had volatility initially on the left tail, so the puts would have been really expensive, and then we had volatility on the right tail, and then the calls would have been really expensive. So it's kind of fun to reverse engineer all of this. So here's what the one I was talking about was the war. Now, the war happened just before the March contract expires. That's the blue one, so we can't infer too much. But what we can say is that the closer one, the next one after March, is the July contract, okay? And volatility, basically during the time of the invasion of the wheat price, just shot right up. And not surprisingly, because when Russia's invading Ukraine, no one knows what's going to go on with the ports and how long the blockade's going to happen. So the volatility spiked. But when you look at the following September, nobody's too worried. I think people thought the war was going to be over by then. So we have some increase in volatility, but it comes down pretty quick. And then I think here, I haven't followed it yet, but I think here is where The volatility has come down because I think there's going to be reassurances that the port will be reopened and that we'll get the food out after all. So we learn a lot just by looking at this overall volatility. Now let's look at the smile for wheat. So this is the current smile. No, I say current just before the invasion of the Hamas-Israel conflict. I'm doing these slides last minute, like, wow, I can't keep up with all this stuff. This is sort of what we would have thought under fairly normal times. October 5th. Yeah, just before. I think the invasion was October 7th, though. So this would be sort of pre-invasion. Now, this is your typical smile for wheat, okay? Basically, traders are saying, yeah, we've got some downside risk. The put options are kind of trading above what Black-Scholes says, but we've got more upside risk. And I think that just, again, reflects, the nature of the war in Ukraine, the uncertainty. Maybe Russia will continue to block the ports. So this here just tells me that it's somewhat symmetrical, that the downside risk and the upside risk are similar, but there's a bit more emphasis on the upside risk given this kind of skewed smile. They call this, skewness, but we won't get into that. Okay, now, when Russia invaded Ukraine, traders became very concerned about price surges due to the blockade, like I mentioned before. So let's look at how the volatility smile changes just before the war, February 1 of 2022. In the early days of the invasion, March 2nd. So remember, the war was the invasion was February 24th. These are the early days, and then the war is well underway. Let's look at how this volatility smile changes to see if we can understand how traders are looking at the left tail, like the downside risk versus the upside risk. So here we are, first of all, in the early days. This is the pre-war, and there's very little trades. The options are thinly traded. The volatility is low. If anything, there's a little bit of upside because, again, things were already happening in the war, prior to the war, worried about wheat prices rising. Things really started happening here is when the war just gets underway. That's the green one. So now we start to see a bit more of a pronounced smile. But I think here is what's most interesting. This is the war is well underway. And now we can clearly see that traders are really much more worried about the potential for a large price increase in the wheat market, okay, either from a further blockade or something like that. So the smile is stretching way out to the right. Okay, let's now talk about the volatility smile in the early days of the pandemic. Okay. So first of all, it's probably similar to the war in the sense that after the pandemic, shortages, initially downside risk, but then more importantly, upside risk. So let's see how that unfolds. So this is this here is where the pandemic, I'm not sure why I've chose February 14th as the marker point. I think that was something significant. Anyhow, the puts do a little bit, but people by this point aren't too worried about the price, collapsing. They're much more worried about the black swan events of the price rising to a very, very high level. And finally, I think I'm getting close to my last slides here. This here is basically the growth rate in the puts and calls, okay? And in the early days of the pandemic, the calls were growing much faster than the puts, okay? Which meant that, let's see. I thought I had that reversed here. I'm going to just not comment on this. This one is from a former slide deck, and I didn't take the time to think that through. I got it backwards now. I'll just leave that one. Okay, so that kind of wraps up my formal stuff, but I might just take a couple minutes and explain what I mean by the roll yield myth. I find it quite fascinating, and I'll just need 5 minutes for this, and then we'll take some time for some questions. So let me just go way back here. Way back here. Yeah. So here I told you about what index hedge funds do, okay? So basically they're starting to, right now in November, all the hedge funds are trading these November contracts, okay? But they're getting ready to roll out of them into the December contracts. Think of this for crude oil, because crude oil trades every month, okay? We don't have to worry about the gaps between trading. So next month, a month from now, all these index funds are going to be in trading December contracts. And then a month from now, later, they'll all be trading January contracts. So they call that rolling your position. You're rolling it into the next nearest contract month, right? Now, I think I'm not going to go back to the slides, so I'm just going to explain the story. There's this myth out there, right, which I find interesting, kind of behavioral, that traders believe that if you're moving from, say here would be an example, if you're rolling out of this contract and buying into this contract, that's got to be bad because you're selling at this price and you're buying at that price. And then you're doing the same thing. You're selling at this price and you're buying at that price. So there's this belief that when the market's in contango, you're going to lose money by investing in an index fund. They say you should invest only when the market is in backwardation. So that's much better, right? Because you're selling high and then you're buying low. Selling high, buying low. And it's quite amazing at how much is written out there about the value of investing in index funds in a backwardation market versus a contango market, especially in the oil, right? And it's a myth. And despite even economists writing about this, the media just doesn't try to pick it up to explain. It's quite fascinating. What the reality is that you are not selling low and buying high. For each contract, you're buying at the beginning of this contract and you're selling at the end of the contract. So it's how this contract moves from the beginning to the end is what's important. It's not important how you move what the spread is between the contracts, if that makes any sense at all. And again, there's no reason to expect the November contract to systematically go up over time or systematically go over time. You shouldn't be able to, you should be at best sort of break even by holding these futures contracts. Anyhow, there's this really interesting myth and I kind of find it quite intriguing. I think I'm going to stop there and we can take some questions. I hope you found some of this interesting. And the takeaways, contango versus backwardation. Contango might be a dance, but it also means an upper sloping forward curve. And remember your puts versus calls. Thank you.
So these are events, pandemic, war. I'm just thinking of Western Canada right now where we have change in policy, where like the biodiesel policy and how it's having shifts in the markets. And I'm just like, are you using the same tools to assess the impact of a policy change and the investments that we're seeing in Western Canada in terms of the impact on the fuel price?
That's a very good question. One of the good things about looking at events like wars and pandemics is that they're unexpected. When something's unexpected, the data reveals sharp changes. But if, like something like a policy, if you anticipate that it's coming, like if you know the biodiesel policy has been talked about for months and it's finally moving itself through and then it gets enacted, that's already been factored into the prices likely. So you're not going to see, you don't know when to actually measure the change. If it comes out of the blue, like if suddenly Poilievre becomes prime minister and cancels the carbon tax without warning, that would be a time when you would definitely see the data would reflect it. But so in other words, the more surprising the policy is, the more you're going to be able to capture it with the data, if that makes sense. Yeah. Derek?
You have been talking about events, and I think a drought is a relatively short-term event, but if we're concerned about climate change, pronounced drop in yield, say, that could look like contango, right? It might appear like that, but it's for a different reason.
Derek, I think you might fail the exam. Backwardation. No, you might be right. I was just teasing you, because you're talking about. I mean, if it's a current drought,
Yes.
due to climate change,
That should look like backwardation.
that's backwardation. But
I
if
did listen.
okay, so you weren't on your phone during class looking at Facebook. Thank you.
I was trying to turn the volume down.
But you're right. If it's a climate change event that we're already worried about El Nino coming in, that's going to create likely lower yields next year. Yeah, then of course we're going to have the contango, like you point out. We want to save stuff now and bring it forward, so we'd have contango. I don't know. It's a bit what I said earlier with climate change. Clearly, these curves are going to respond, but it's a new normal. I think if anything, Derek, would be just higher levels of volatility. Like, I mean, if we would go back and look at the volatility, implied volatility levels from trading options, even 10 years ago before climate change was bad, but not this bad, and look at it now, that might be a really good project for one of your students, okay? You tell them to go ahead and look at the implied volatility of, say, wheat and canola and everything 10 years ago, and now to see whether climate change is systematically, we're just higher volatility because of the likelihood of droughts and bad stuff happening is just that much higher. So we're going to have permanently higher volatility. That's very doable. That's a good research question.
Except the war happened between then and now.
Yeah, that's the problem. Economists love to make these assumptions. We call that ceteris paribus. Hold everything else constant and just focus on this. How do you do that when you got so many weird things happening? I mean, I'm kind of a bit bummed because the Hamas-Israel, how terrible it is, would be a very, very rich data source. I mean, if this talk was even 2 months later, I'm sure I would have taken the time to collect data, because it's not that hard. Once you get sort of used to doing the collection and using the programming, it's not that difficult. I showed you a little bit from the very first slide what happened with the oil volatility on the day. Something weird here, why there seemed to be a delayed response, but I'm sure now after 10 days into the invasion, I'm sure some of the, not just oil markets, but food markets are revealing all sorts of interesting things. So another project for a student, they can have my slides and they can just use all the tools I used, and you say, just explore the Middle East issue now.
Jim?
Hey, Brian.
Yeah, how much difference do you find in terms of looking at what the market's telling you between the two markets you talked about, the oil market, which is a flat, no-carry market, and a seasonal market, which is both seasonal and a full carry? Yeah,
that's actually, I've started finally incorporating oil into my teaching, because for years I only focused on the seasonal markets like soybeans and wheat and these sorts of things, and I was always focusing on the ups and downs. And then I started looking at the crude oil markets, and they've got a fascinating history of, they go 5 years in a row of being in contango, and then they switch into backwardation. And why? Because why would they be in contango? They don't have really a cost of storage like you do with storing, canola and these sorts of things, right? So there it really has to do with inventory and shortages and perceptions of when you need the oil, more so than the actual physical cost of storage like we have with commodities.
Yeah, and then you have gold running in between the two of them.
Yeah, gold would be running in between it, because it's partly, you're right, it's sort of in between. But I mean, oil, you do store it. It's not zero for storing it, but it's just different than, it's not seasonally produced, right?
But in stable times, you can go 10 years out and it'll be flat price.
Right. Yeah, that's what Brian is saying, is that with oil, you don't have to have the rising price to compensate for storage. It's just continually being produced and delivered, so there's not really the kind of storage cost that we have. You only produce it once per year. But then it's weird why all of a sudden oil will switch into backwardation after it's been in contango or flat for years.
Yeah, no, and that's the point on the myth side and so on.
Yeah, that's the whole myth started in the oil market because people hedge funds mostly do invest in oil. They don't mess around too much with wheat and those sorts of things. And they just saw when oil was in backwardation, they called it the golden years. I actually did some research on this, and it turns out to be that there is a correlation for completely different reasons as to why you might make money holding crude oil futures when it's backwardation, and why you might lose it when it's contango. And it's kind of complicated to explain, but it's completely different than what the myth says. But it's hard to dispel the myth, because they say, well, look at the data shows in those years when the markets were in backwardation, we made money, and now it's in contango, we lose money. So what's your explanation? And it's like, yeah, it's not what you're saying. It's just something different.
Any more questions, folks? Then please help me give another round of applause to our speaker.
Yeah, thank you. Thank you. You've been a very patient audience with all the jargon and everything else.
Jim, we have a gift for you. This is a plaque to remind you
Oh.
that you were here as a
Oh.
Kraft Lecture. Thank you very much.
Very much.
Thank you. Thank you, everyone, for coming. Thanks again to the friends of Daryl Kraft and his family, Dan and Myrna. Thank you very much for your support of our department and supporting this lecture. That's it for our Kraft Lecture for today. Have safe travels home, and we'll see you next year. Thanks. I just wanted to say thank you to the person who keeps our trains running on time, who always helps us out, Surrender Combos, and also to Brian Olson for helping to organize. Can we give them a round of applause?